Please donate now.
Welcome to Market Call. For the next half hour, David Burrows, President, Barometer Capital Management, takes your calls and emails on North American large caps. The toll-free number, 1-855-326-6266, or send an email to marketcall@bnn.ca. Great to see you.
Great to see you too.
Is there a case to be made, just buy large cap stocks only if they sell stuff to India and China these days?
Well, you know, certainly that is a key theme, especially if it's a large cap stock that sells consumer products. Certainly some of the great branded companies globally are having tremendous success and really are starting to hit their stride in those markets where the growth is starting to become so significant as it relates to the rest of the business that it's having a material impact on earnings. So certainly that's a theme, and we're focused in that area.
If there is a dramatic decline in the US dollar, that's got to be good for these US big cap stocks.
Yeah, I think that that's true. We don't see a sign of a dramatic decline in US dollar right now. But certainly that would be a real positive for them, just as a rising dollar can be somewhat of a drag on the same companies.
And what areas, say in Canada, what areas are you guys finding value in right now?
You know, the number one biggest investment theme we're focused on is energy infrastructure assets. We've been focused there for the last year, and we think that there are long legs in that space, money to be made for investors.
So we're talking pipelines and then the mid-market energy players, the Pembinas and that?
Yeah, the gas processors, the transmission companies, the storage companies, the truckers, that whole space is benefiting from a rise in production, and we don't see any sign of that changing anytime soon.
We're going to be right back with David Burrows right after this. You know the numbers. Get your emails into marketcall@bnn.ca.
Market Call is brought to you by BMO ETFs. Learn about our comprehensive lineup at bmo.com/ETFs.
Because of Ferdinand Magellan and the demands of the ancient pharaohs. Because of the Orient Express and QE2. Because luxury travel should always be reinvented. That's why our A380 features first-class private suites, an onboard lounge, and shower spas. The Emirates A380. Fly Emirates, Airline of the Year.
Can't believe I'm turning 50. Jenny's engaged. Rebecca's finishing high school. Little Natalie, she's 13. 3 grown daughters.
Dad, can I borrow the car?
Your sister has it. Wow, 50.
You can handle it.
Life adds up. Your finances should too. Visit a CIBC branch today for free financial advice and achieve what matters to you.
Joe in Abbotsford, BC wants to know about Verizon, VSN, on the TSX. I'd like to get David's opinion. It's been on a steady climb. I own some. I'd like to buy some more. And this is another energy infrastructure play.
Yeah, so as I was saying, even in our pure equity portfolios, roughly 30% of the portfolios right now are targeting energy infrastructure assets. So we think that there is a 10-year secular theme in front of us that can lead, A, to rising dividends, and B, to improved valuations. So we can get a multiple expansion and a rising dividend, which could give you a geometric lift in share price. Within that camp, there's a number of them that we own. We do not own Veresen currently. You know, Veresen's best known for that 50% interest in the Alliance Pipeline. And one of the key themes is that much of the liquid-rich gas that they have typically transported down to south of Chicago at Aux Sable is being diverted to other processors in Western Canada to keep the liquids in Western Canada because the demand for liquid-rich gas is going higher. So there's a lot of competition for that gas. And there are several contracts that come up for renewal over the next few years that we think pose some risk to Veresen, where some of the other infrastructure companies don't have that same issue. So we prefer some of the other companies. Veresen is in the right space. They're doing very well. I just think that there might be better names, and we'll talk about one of them later today.
For sure. So the yield on Veresen right now, 7%.
Yeah, it's excellent, but I just think that there is a risk there that some of the others don't have.
Lisa's on the line from Toronto. Go ahead, Lisa.
Hi, thank you for taking my call.
Not at all.
Mr. Bowers, in the past you've recommended Canfor Pulp, which I purchased and did very well, and then sold it upon your recommendation. I know it's been dropping dramatically. I'd like to know what the reason is. Is it a sector section, a problem? And do you think it's time to re-enter? I'll hang up and listen to your comment. Thank you very much.
So, Lisa, I'm glad you did exit when we went to the sidelines. This was a great holding that we were in, but of course it is economically sensitive. And one of the key themes that we saw over the course of the summer, even as the market, was holding up at times, the more economically sensitive companies were underperforming. And there is some question around pricing for Canfor, and of course their distribution or their dividend is dependent on strong pricing. So this is one that we've stayed away from. We tend to try through a difficult market to look for the companies that hold up better than the rest. This has not been one of them. I think that you can wait on this one for a different opportunity. I think that the appetite in the market is for more predictability and more visibility in the ability to pay, and this one, has some sensitivity to the economy.
Here is John on the line from Tillsonburg, Ontario. Go ahead, John.
Hello, David.
Hi there, John.
My question's on Corning. I see today their stock's down roughly 14%. On news that consolidated equity earnings are going to be down 30% versus guidance of 5%. Can you tell me, is this a sign of the economic times, or is management that incompetent, or maybe that's too strong a word to not have a better prediction?
The difficulty here is that we're in a market where even companies that are hitting the numbers and doing relatively well are being called into question as to the sustainability. In the case of Corning, the last 3 earnings numbers have been negative. They got a negative growth rate there. There's questionability again around the sustainability of the earnings, and so I think investors are using the opportunity for any kind of bid in the market to exit companies where there are some questions. And today you've got a quieter market. They've raised more questions about earnings going forward, and the market's voting with their feet. This time of year, you're going to see a lot of these stocks that have underperformed over the course of the year get punted from portfolios, because managers don't want them on the sheets to show how inept that they've been, perhaps. And second, of course, there's the tax loss selling that takes place. So.
Yeah, and it seems to be that a customer, they cut prices to accommodate a customer, and then the customer abandoned the contract anyway.
Right. So there's no win there.
James is on the line from London, Ontario. Go ahead, James.
Mr. Burrows, always a pleasure to see you on. My question is on Kinross Gold. I'm pretty well aware of, the Show Me story with the purchase of Redback. It seems as though they've diluted themselves at least 60% since that acquisition. But can you just basically comment, is value ever going to kick in on this stock? It seems to be trading pretty much around net asset value at the time right now. Is value ever going to kick in here?
So, I tend to try and speak to the way that we look through the lenses, and, everybody's going to have a different approach on things. My view is, we come from the top down and say, first of all, market-wise, are we putting money to work? Second, is this a sector that we're focused on? Is there new net money flowing into this group? And I think, first off, that's a question mark, right? That the gold producers have been underperforming the metal and, frankly, underperforming the rest of the market. And then the third thing, is it a leading stock within the group that would be garnering new net buyers to the name? And I think in the case of Kinross, really, it's about the worst performing big gold producer. I'm not the one to try and buy something based on pure valuation. I do think we are in a challenged market, and I do think that there are risks. So if you don't have everything going for you, I think you got a tough slug ahead. Technically, the stock broke to new lows recently. I would steer clear. We have very low gold weight. We've only got a couple of names. We've got some Alicer, and we've got some a little bit of Eldorado. We got some Newmont. But those would be among the stronger performers. And I just think that you don't, again, we're not in the kind of market where investors will invest in things that have a little bit of hair on them, and I think that Kinross is in that camp right now.
Dave is on the line from Saskatoon. Fire ahead, Dave.
Thanks for taking my call.
That's all.
My question is regarding Bank of Nova Scotia for long-term holding, and also place of Bank of Nova Scotia among the three Bank of Nova Scotia, TD, and Royal. Thank you very much.
Thanks very much.
Okay. So, Dave, going back to start at the sector level, obviously financials have had a very difficult year in general globally. Canadian financials really played catch-up over the last quarter to the downside. Within the financials group, one of the concerns is which companies could be impacted negatively by what's going on in Europe. And, you know, Bank of Nova Scotia has made lots of investments that have worked quite well along the way in South America and the Caribbean. South America does have a more significant risk to what's going on in Spain because some of the big Spanish banks have large exposure in South America. If they're pulling back in South America, there's larger risks, and I think that that's why Bank of Nova Scotia is underperforming right now. So the European situation is posing a little bit more risk to some of the growth opportunities that Scotia is seeing. Within the group, I think that Royal has the most significant exposure to capital markets in the U.S., so I would stay away there. Scotia, we just talked about, I would be more inclined to be in a TD, although as unusual as it may be, we have about a 0% weight in financials, because in general, we think that they're having a hard time returning a strong return on equity, and the dividend growth that people have become so accustomed to over the last 15 years really is not likely to be there, so we think their earnings multiple could compress over time, and these could continue to underperform.
We're going to be right back with David Burrows, President, Barometer Capital Management, answering your questions on North American large caps. The number, 1-855-326-6266.
Fast-paced debate for fast-paced finance. Market traders and portfolio managers talk stocks, strategies, and the secrets of success. Market Sense, Monday through Thursday, 5 Eastern, 2 Pacific, on BNN.
With iShares fixed income ETFs, there's a lot built in, like diversification. So instead of a handful of bonds, you get hundreds for lower volatility. And it's not only in our funds, it's in our DNA. iShares ETFs, listed on TSX.
Argex has high-quality titanium dioxide in Quebec, used in the $100 billion paints and coatings industry. Argex is poised for development and anticipates their preliminary economic assessment in Q3 of 2011.
The inspiration for its shape was an archer drawing his bow. Could that have also inspired its 556 horsepower supercharged engine? Cadillac CT-SV Coupe. We don't just make luxury cars, we make Cadillacs.
Closed casting of this program is brought to you by Interactive Brokers. Deep discount direct access. 90+ markets worldwide.
Before we get back to those calls and emails, remember, if you never want to miss the top picks on Market Call, we'll send them straight to your inbox. Each night, we'll send out those top picks and analysis from our experts on the shows. You go to bnn.ca/subscribe to sign up. You'll also get Marty Say's mordacious commentary on the market-moving stories every morning. Here's an email from James in Toronto. The subject is Visa. He writes, since we're getting into the seasonal shopping period, would Visa be a good bet?
Right. So, first of all, as far as a theme goes, in financial services, probably the only theme we really like are the card issuers. So whether you're talking about Visa, whether you're talking about MasterCard, whether you're talking about Discover, the whole group, even Amex, looks pretty good. Why? Well, first of all, there's two ways that you pay using a Visa card. There's a fee that Visa gets paid, and then there's the spread that you pay on the interest that you pay on your balance.
Do you ever?
So the banks love that business. It's the most profitable business that they have. In the case of Visa, Visa's customers tend to be the high-end customer who use their card a lot. So Visa has a very strong franchise in the most valuable part of the market, which is great. The banks like to promote that business because it provides them good margins, and it's a global growth story. They're growing in North America, yes, but there's great growth globally. MasterCard we prefer. So I'd invest in Visa. We don't own it. We own MasterCard. And we own MasterCard. It's a more mid-market constituency, but it's faster growth, and they've got more global growth. They've done a better job overseas. But I think in general, you want to own the things that the issuers really want to support, and the interest spreads are so good for the banks that you can expect that they're going to continue to try and grow this business, and we think that it's very, very attractive.
So you'd pick MasterCard right now over Visa?
I'd pick MasterCard over Visa, but I'd be happy to own them both.
Sure. We've got John on the line from Ajax, Ontario. Go ahead, John.
Hello, Andy and David. Hi. We always appreciate your opinion about and insight about the stocks. My question is about CAE. I do already have Bombardier in the same account. Now I'm thinking whether should I buy or establish a position in CAE or Finning. Thank you very much for your opinion. And Andy, you need to enlarge this show to 1 hour. Thank you.
Oh my goodness, I'll pass that on. Yeah, well, it's an hour in the evening. But you want an hour in the middle of the day too?
Of course.
Okay, thanks. I'll pass that on to our glorious leaders. Thanks.
Again, focusing on specific themes that are in this marketplace, one of the key themes is the aerospace industry and companies that are benefiting around the replacement cycle in jets. And you could put CAE in that camp. The problem is they're not really winning. We would prefer, if we're going to be in the aerospace area, to be in one of the parts providers. Companies that are selling both into Boeing and into Airbus. And so we've talked before about companies like Precision Castparts, Triumph Group, and there's quite a number of companies in that space. CAE has been a weaker performing stock in the group, and again, we're looking for a strong sector and leading stock in the group. And so I would prefer to look outside of Canada and look at one of the larger global parts providers.
Okay, that's the way you play aviation.
Yes.
You're confident, though, aviation's in a bull market longer term?
Yeah, the international market is just so strong, and it's not so much about worrying about AMR, it's worrying about the quickly growing international companies. There's a big replacement cycle because, of course, the new planes are so much more energy efficient that the airlines need to replace these planes. And we want to be agnostic to Airbus or Boeing. We want to own the companies that are benefiting from growth in both.
Tony's on the line from Calgary. Go ahead, Tony.
Hi, thanks for taking my call. I'd like to ask David about the oil and gas service sector. It's that time of year where they're kicking into high gear there. What does he think about the whole sector? Or did you like Calfrac? Thanks.
Sure. Well, first of all, on a sector basis, we really like the services companies, but specifically the ones that are benefiting from some of the newer technologies that are being used. Calfrac fits right into that camp. And so, yes, we quite like Calfrac. There are others in the U.S. that we like also, but I think this is a theme you're going to continue to see. These companies are going to make a lot of money. There's tremendous demand right now for services. You've got interesting growth oil camps all over North America, and I think that Calfrac could be a big beneficiary.
The stock's been a bit weak there lately.
Yeah, certainly the sector pulled back with the market. Some held in a little better, some held in a little worse, but the fundamental characteristics are so compelling. You did hang in well above the lows from early October when we put in the first low in this market. Yeah, it certainly pulled back, but it didn't break down technically.
Lou is on the line from Mississauga, Ontario. Lou, you're on the air.
Thanks for taking my call. David, I'd like to ask you a question regarding Manulife. I have quite a bit of it and wondering if I should sell. I have around 7,500 shares of the damn thing.
Right.
What do you think I should do?
Lou, this is a tough one for a lot of Canadian investors because it's a widely held stock and it's been a really tough performer. The problem is, first of all, you're in a very difficult neighborhood. The insurance companies are having a hard time. And when it comes down to it, there's three things you want to look at in these companies. First of all, do they have growth in the products they're selling? And Manulife has had some challenges in growing because some of the high growth products they had in 2008, 2007 are products they're no longer selling, turned out to have too much market risk. When you look at the way an insurance company makes their money, largely, it comes down to can they generate a return on the premiums that they get paid in excess of what they're going to owe to pay out. And one of the big contributors to that is how they do in their bond portfolio. With long-term bonds at 2%, it's hard to see how they get a lot of excess return there. So low interest rates really hurt insurance companies. The second place, of course, is how they do on their equity portfolios. And equity markets, as we all know, have been very, very volatile. So in this kind of environment, there's not a lot of people who want to make big bets on the insurance companies unless you think rates are going higher or equities are going to march their way higher. And neither of those two things are wildly apparent at this point. So we would stay clear of the industry in general. We're actually short a couple of insurance companies, not Manulife. But I think it's the financials in general, again, are a tough camp to be in.
Can you tell us who you're short?
I'm going to have to if I get a question later on it.
Okay. Somebody email David. Let's find out who he's short. Give us one name. Who have you gone short on?
We've been short Sun Life.
Okay.
But frankly, you know, the whole industry is having a difficult time, and we don't think interest rates are going up anytime soon, and we do think that the next year there could be some challenges on the equity side. So we're very cautious in this space.
Coming up, we're going to get to David's top picks. And remember, he's got an energy mid-market player for you. He sees more upside for this one.
It's up to you what you do with your money. With Questrade's low $4.95 trades, you'll save a bundle while you're making it.
There are millions of mortgages in Canada. If you have one, you have a Manulife One number. Take Mike, for example. Mike and his wife Sarah have a mortgage, line of credit, car loan, and several savings and checking accounts. Simply by combining all their inefficient accounts into the revolutionary Manulife One, Mike calculated they could save $46,980 in interest and own their home years sooner. Discover your Manulife One number today at manulifeone.ca.
Join us Wednesday on Market Call when Greg Newman, Senior Wealth Advisor at the Newman Group, Scotia McLeod, will take questions on Canadian dividend stocks and protection strategies. Get a head start. Market Call at bnn.ca.
I love these guys. I love Bob and Jack over there. I even love their best friend, Steve-O, the Joker. So who's it gonna be this time? Doesn't matter. I'll get one of you. I always do.
Make death wait. Please donate to fund life-giving research because heart disease and stroke take 1 in 3 before their time.
The lighter you are, the more agile you are.
Open road, open sky.
Top Picks is brought to you by Questrade, where you can trade stocks for $4.95.
David's first top pick is McDonald's. The stock's up just over 20% this year. You're not worried that it's had too much of a run?
No. So one of the core leadership themes in the market is companies with predictable cash flows, where you've got visibility out going forward, where you're getting a yield. Yield, I think, is really important in this market.
3%
and
here.
Has been over the course of the year, especially if it can be yield that grows over time. So over the last 3 years, McDonald's has returned about $75 billion to their shareholders by way of share buybacks and dividends. It pays a 3% yield. They have very strong global growth. Their same-store sales in Asia are running at like 13 to 15%. So you've got a very predictable business. They've increased the profitability by bringing things like McCafe, and they're bringing new people into the stores.
Stores are looking better, more contemporary?
They're looking better. If you walk into the one downtown Toronto here, the lineup's out the door to buy coffee first thing in the morning. But it's really interesting. We all like REITs. REITs have been doing very well. 2/3 of their revenue comes from rental revenue on the stores they have around the world. They own the real estate, right? So yes, it's great that they get the royalty revenue. That's about 4% of sales. That's about 1/3. But 2/3 of it comes really from running a giant REIT. Now, if you think they're going to be able to continue to grow globally, which they are, and we're doing a very nice job of, and if you think that they continue to be profitable, now they've been raising their prices and becoming more profitable, they should be able to continue to buy back stock and continue to raise their dividend. And these aren't terribly economically sensitive stores that they're operating. So we like this one. It's a global brand that we think has traction internationally and a very stable revenue base. And there's no wonder it's up 20%. We think it will continue to grow and continue to work its way higher.
AltaGas, mid-market player you like?
Yeah, really like energy infrastructure, as we talked about, because of all of the new finds all over North America that are creating more volumes that need to be transported. About 50% of their revenue comes from transmission of gas, and that is growing. About 33% is from their power segment, power transmission. They will probably double their EBITDA by 2017. So you pick up a 5% yield. Their EBITDA probably doubles over the next 5 years. And they just made this purchase of Pacific Northern Gas Pipeline, which gives them now a foothold into Kitimat to develop future liquefied natural gas business for export. So we like these companies that are benefiting from the increased volumes out there. They're long life assets. They pay good yields and will get yield plus some improvement by way of a rising dividend.
So you like yield, but cash is one of your top picks.
Yeah, and we continue to see issues in the broad equity market, and it's not lost on us about Europe and risks in China. The things I notice that I just highlight is that even on the rally days, the defensive stocks are the ones that are doing well. Second, volatility is very, very high, and I think that it's a good thing to have a little flexibility in the portfolio right now. I think that there's lots of risks that we're all dealing with.
David, let's gallop through your past picks, and this is from December of last year. We got to Peyto Exploration. Wow, what a star still, up 32%. Union Pacific Railroad, not doing too badly, up 8%. And Caterpillar, hanging in there, up 1%. Look at that. Would you still be a buyer of Peyto right now?
Still buy Peyto. It's a big holding. Union Pacific, we traded to Kansas City Southern. We really like the rails. And finally, on the Caterpillar, we're away from the equipment stocks today. We sold that in the spring. It's less economically sensitive stocks, attractive now.
David, thanks so much.
Thanks very much for having me, Andy.
David Burrows, we're out of time on Market Call. Thanks very much indeed for watching. We'll be back at the same time tomorrow. Have a good day in the markets.
You expect refinement. You crave technology. But you never imagined anything quite like this. Introducing the 2012 Lincoln MKX. Get it all with the lease or purchase finance rate as low as 0% for up to 48 months. Plus, eligible Costco members receive an additional $1,000. Lincoln, it's not just luxury, it's smarter than that.
Lincoln Mining is developing a portfolio of precious metals projects in North America. Lincoln is collaborating with Elgin Mining to advance its projects. Lincoln is a company to watch on the TSX venture under LMG.
Canadian-based gold producer Richmont has produced 1.2 million ounces of gold, and with 2 mines in operation and a third opening in early 2012, Richmont is targeting annual production growth of over 17% in 2011 and 2012.
This man is on vacation. This man is also on vacation. This man is about to make a big move in his stock portfolio. This man is not. Because while this man is using his smartphone to watch the Business News Network live, this man is using his to play solitaire. BNN, wherever you go. Now available on Bell smartphones and tablets.
There's a thin line between a good photograph and a great one. It's how a Canon portrait lens can bring out what really counts to you. Add a wide-angle lens and go from nice shot to I can't believe you took that shot. Or choose a telephoto lens and change your view from the stands to the crease. Cross the line from good to great with world-renowned Canon lenses and see the world differently.